My name is Rajuk C. Dix, financial advisor and founder of the Goods Virtual World. Welcome back to Good Wealth. In Module 1, we mastered the client. In Module 2, we mastered investment company structures. Now we move into one of the most misunderstood areas in finance, variable products, and more importantly, how risk is transferred through the financial system. Because once you understand this module, you stop seeing variable annuities and variable life insurance as products. You start seeing them as engineered financial structures. Let's begin with the core principle. A fixed product transfers risk to the insurance company. A variable product transfers risk to the investor. Write this down. Fixed equals insurer risk. Variable equals investor risk. That distinction controls almost every exam question in this category. Now let's slow this down and make it real. Imagine two clients. Client 1 says, "I need guarantees. I cannot afford to lose principal." Client 2 says, "I want long-term growth, and I understand market volatility." Pause and think. Should these clients own the same product? No, because their risk capacity and objectives are completely different. Now let's go deeper. A variable annuity is a contract between an investor and an insurance company where capital is invested into market-based sub-accounts. Those sub-accounts behave similarly to mutual funds. But here is the elite-level distinction. The investor's capital is held inside a separate account. Write this down. Separate accounts isolate investor capital from the insurer's general account. That matters because the investment performance inside the separate account determines the value of the contract. If the market rises, the value rises. If the market falls, the value falls. The insurance company does not absorb the market loss. The investor does. Now let's apply this. Which of the following statements regarding a variable annuity is true? A. The insurance company guarantees investment performance. B. Assets are held in the insurer's general account. C. Investment risk is assumed by the investor. D. Returns are fixed annually. The correct answer is C, because variable products transfer investment risk to the client. Now let's elevate the language. Variable products expose clients to market risk in exchange for capital appreciation potential and tax-deferred growth. Write this down. Variable products trade guarantees for growth potential. Now let's talk about taxation. One reason investors use annuities is tax deferral. This means capital grows without current taxation until withdrawal. Pause and think. Why is this powerful? Because untaxed growth compounds faster over time. Now here's the trap. Tax deferral does not mean tax avoidance. Write this down. Tax deferred means taxes are delayed, not eliminated. Now let's go Ivy League level. Compounding is one of the most important forces in finance. When gains generate additional gains over long periods of time, capital accelerates exponentially. This is why time horizon matters so much. A younger investor benefits more from tax-deferred growth because time amplifies compounding. Now let's connect this to suitability. A 32-year-old investor with stable income and long-term retirement objectives wants tax-deferred growth and accepts market volatility. Which product is most suitable? A. Fixed annuity. B. Variable annuity. C. Money market fund. D. Treasury bill. The correct answer is B, because the client has long time horizon, growth objectives, risk capacity, risk tolerance. Now let's break the wrong answers. Fixed annuity prioritizes guarantees, not growth. Money market funds prioritize liquidity and stability. Treasury bills prioritize safety and short-term preservation. The variable annuity aligns with the client's objectives. That is suitability. Now let's move to another critical concept: accumulation phase versus annuitization phase. The accumulation phase is when the investor contributes capital and grows the account. Annuitization is when the contract converts into income payments. Write this down. Accumulation builds capital. Annuitization distributes capital. Now let's talk about mortality risk. This is one of the most important concepts in insurance and annuities. Mortality risk is the risk of living longer than expected and exhausting financial resources. Annuities exist partly to mitigate that risk, but elite advisors understand another layer. Mortality risk is often paired with expense risk. Expense risk is the guarantee that the insurance company will not increase administrative costs, even if their own internal expenses rise. This is the price of the safety net. Write this down. Mortality risk protects against outliving capital. Expense risk protects against rising insurer costs. Pause and think. Why would retirees value guaranteed lifetime income? Because it reduces uncertainty. Now let's move into behavioral finance. Most clients think risk means losing money. Elite advisors understand risk is broader than that. There are multiple forms of risk: market risk, inflation risk, liquidity risk, interest rate risk, longevity risk. Write this down. Risk is multidimensional. Now let's apply it. A retiree keeps all capital in cash to avoid risk. Ask yourself, are they truly avoiding risk? No, they are increasing inflation risk. Over time, purchasing power declines. This is one of the biggest mistakes investors make. Elite advisors do not simply avoid volatility. They balance competing risks simultaneously. Now let's discuss prospectuses. Variable contracts are considered securities. Because of this, they require a prospectus, FINRA registration, SEC oversight. Write this down. Variable products are securities regulated by both FINRA and the SEC. That dual regulation is a common exam concept. Now let's apply another question. Which document must be provided to an investor purchasing a variable annuity? A. Balance sheet. B. Prospectus. C. Corporate resolution. D. Trust agreement. The correct answer is B, because variable products are securities and require prospectus delivery. Now let's move into one of the highest level distinctions. Risk tolerance is emotional. Risk capacity is mathematical. A client may emotionally desire aggressive growth, while financially lacking the ability to withstand losses. And this is where elite advisors separate themselves. They do not let emotion override mathematics. Write this down. Professional suitability prioritizes risk capacity over emotional excitement. Now step back and connect this module. Variable products are not inherently good or bad. They are tools. And every tool must align with objectives, time horizon, tax considerations, liquidity needs, behavioral tendencies. Risk capacity. That is how professionals think. Now final lock. Variable annuities transfer investment risk to the investor. Separate accounts isolate investor assets from insurer assets. Variable products offer tax-deferred growth. Tax deferral delays taxation, not eliminates it. Accumulation grows capital. Annuitization distributes income. Mortality risk protects against outliving capital. Expense risk protects against rising insurer costs. Inflation risk erodes purchasing power over time. Risk is multidimensional. Variable products require a prospectus. FINRA and the SEC regulate variable contracts. Risk capacity overrides emotional risk tolerance. Suitability aligns products with objectives and structure. If you understand this at this level, you are no longer memorizing definitions. You are understanding how capital, risk, psychology, and regulation interact inside the financial system. And that is the difference between passing an exam and operating like an elite advisor. You just got the goods from the goods.